Welcome to this Killick Explains video. This time I want to consider one of the most famous investors around, Warren Buffett, and one of the most famous things he's ever said. And Warren Buffett's rule number one is don't lose money. And that's a rule aimed at investors. And then he quipped, rule number two is see rule number one. Now, why is not losing money so important, and what does it actually mean? Well, over the short term, the maths works against you, if you like, if you actually lose money. Let's say you start with £100 and you're unlucky enough to invest it in something that drops by 50%, and then being impatient, which is something I don't recommend, you cash in your investment, well, you've lost half your money. £100 has been turned into 50. But to get back, were you to stay invested to the original £100, you need your money to double in value or increase by 100%. So the way up has got harder than the way down, and that does to some extent, but only some extent, explain our natural loss aversion as investors. And I discussed some of these behavioural biases in other videos. But what did Warren Buffett actually mean? Because there's a danger with interpreting his rule number one, don't lose money, too literally, that you do exactly that by default. So I ran a short poll, as some of you would have expected, to see what people think on this particular topic. And the answers I got were as follows. For the response, it means avoid risk. 16.7% of you went for that one. That wasn't the winning answer. The winning answer was stick to what you know and buy what you know. And that attracted 74.3% of the votes. Come back to that in a moment. Then there was, it means aim to beat inflation. And that attracted 6.9% of the votes. And finally I offered aim for income rather than capital growth, if you're an equity investor, for example, and that just polled 2.1% of the total votes. So let's just go back through one or two of these answers in a little bit more detail and make sure we've got the right angle on Warren Buffett's famous don't lose money rule. Avoiding risk, that is not what he meant. Risk and return go hand in hand in financial markets. If you simply stuff your money under the mattress or leave it idling in a bank account, earning very little interest, you will eventually lose money. And that's because of the compound effect of inflation, when inflation is above the rate you can earn on your savings. And if your money's under the mattress, that rate is zero. So avoiding risk is not an option. In fact, avoiding risk in life in general is not really an option. We take risks every day when we climb out of bed. And Warren Buffett's view was, no, don't play it completely safe. Otherwise, over the long term, inflation will chew away at what's called the real value of your investments, their purchasing power. But do understand the relationship between risk and return and behave in a way that doesn't maximize risk at the expense of return. So in my first example, it's really not a good idea to go into a market where you could lose, say, 50% of your capital in a very short space of time, only to then panic if and when that happens, because perhaps you haven't understood the risks, bail out into cash, and then be sitting on a situation where you may never go back into the market. You've had your fingers burnt, you've lost 50%, you call it a day. That is not what investing's all about. So avoiding risk, no, but understanding that over the short term prices can fluctuate. It is the price we pay for long-term returns. And the Barclays Equity Gilt Study has shown that over the long term, UK equities, for example, can return 5 to 6% after inflation, but you've got to survive some fairly big blips on the way to getting that sort of number. Now, buy what you know was answer two. Pretty sensible, 74.3%. Warren Buffett does own a wide range and has owned a wide range of stocks, everything from airlines through to railroads and some less well understood areas of the market as well. But he does have a rule of thumb which says that he'll only buy once he's done enough homework alongside his investing partner Charlie Munger long-term investing partner and once his team are happy with the outcome. Terry Smith, very successful fund manager, is the same. He won't buy things that he doesn't understand. He won't be lured into exotic derivative-backed products, for example, or indeed derivatives in general as a rule of thumb. And he needs to understand where returns are being driven from when it comes to individual stock holdings. So that is a good rule of thumb. You are much less likely to get missold something if you avoid it, having decided you don't understand it, or at the very least get someone else to explain it first. So I'm glad a lot of people said buy what you know is a key rule when it comes to not losing money. Now, aiming to beat inflation, only 6.9% of the people who responded to the poll went for that, but actually it's not a bad answer, because over the long term, if you don't aim to beat inflation, the real value of your funds, your capital, will be eroded. The convenient rule of 72 says that if you take 72 and divide it by an expected inflation rate, you get the length of time approximately it'll take to halve the value of your capital. So were inflation to hit, say, 10%, unlikely at the moment you might think, that period would only be 7 years, and so on. Now it's a crude rule, but it does suggest that actually trying to beat inflation and weathering a bit of volatility in the meantime to do so over the long term is in fact a valid strategy. Finally, going for income. Now, in the old days, that was a way of reducing risk, reducing the risk of losing money if you like. Steady, dividend-paying stocks that hadn't cut or suspended their dividend for years often were respectable performance in share price terms too. But the problem with going for income, and I'm glad a lot of people didn't just tick that box, if you like, is that you get a very crowded trade these days. The number of stocks offering a consistent, steady dividend yield is diminishing over time. That results in people chasing those stocks, overpaying for them. And actually the reality is that for somebody who's looking, for example, to draw down a pension fund, a mixture of income and or capital withdrawals is possibly a better strategy. Targeting income the whole time, then aiming only to spend your income, let's say once you've built a fund, is a somewhat outdated approach and unfortunately is pretty difficult to achieve at a comfortable level of risk on the way up, as it were, for most people. So rule number one is clearly important. Losses do hurt, especially in the short term, but really what Warren Buffett was getting at was don't completely avoid risk. That's going to get you nowhere in terms of growth over the long term. Do stick to what you know, stick to what you understand. I would suggest long term you do need to aim to beat inflation, because if you don't, you are gradually eroding the purchasing power of your capital, or to put it another way, you're getting poorer in real terms. Going for income, I tend to agree, used to be what a lot of people would try to do. There is a logic to it, but is increasingly expensive and difficult strategy to pull off. If you'd like to hear more on some of these quite big topics, please do go to my extensive video library, killick.com/learn, and I've also got a set of guides available, one of which is called How to Invest in Equities, and if you ping me an email, editor@killick.com, we'll be happy to send you a copy.